What if the most powerful financial institutions in the world are showing signs of panic that they cannot hide anymore? And what if the questions now being raised go straight to the heart of how the entire system actually operates? This is the situation unfolding right now as Wall Street experiences levels of volatility and uncertainty that have traders and analysts openly questioning whether something deeper is breaking beneath the surface. And in the middle of this turmoil, Donald Trump has emerged, demanding answers about decisions being made behind closed doors that affect every American, yet remain shielded from public scrutiny. The timing of this confrontation is not accidental. It comes as financial markets are sending signals that do not match the reassuring narratives being pushed by institutions that depend on public confidence for their survival. Let us examine what is actually happening and why it matters. Wall Street has entered a period of intense volatility, driven by converging pressures that no single policy can resolve. Reports indicate that trading desks at major financial institutions have been experiencing whipsaw movements that are making risk management increasingly difficult. The VIX, often called the fear index, has spiked repeatedly in recent sessions, reflecting hedging activity that suggests institutional investors are preparing for scenarios far worse than their public statements acknowledge. Sources familiar with trading floor discussions describe an atmosphere of anxiety that goes beyond normal market fluctuations. There is a sense that the rules governing how markets function may be changing in ways that established models cannot capture. Trump has seized on this moment to demand transparency from institutions that have historically operated with minimal accountability. His specific targets include the Federal Reserve, the Securities and Exchange Commission, and the major Wall Street banks that he claims have been manipulating markets for their own benefit, while ordinary investors bear the losses. Whether these claims are fully accurate is a matter of debate, but the underlying concerns resonate with millions who watched their portfolios decline while executives collected bonuses, and insiders seem to know when to exit. The Federal Reserve finds itself under renewed pressure from multiple directions simultaneously. Chair Jerome Powell has attempted to maintain a steady public posture, emphasizing data dependence and gradualism in policy decisions. But sources suggest internal divisions within the Federal Open Market Committee have intensified as different members advocate for contradictory responses to current conditions. Some officials reportedly favor immediate rate cuts to prevent financial accidents, while others warn that premature easing would reignite inflation and destroy the Fed's remaining credibility. This paralysis at the top of the monetary system is itself a source of market anxiety. When the institution responsible for backstopping the financial system appears uncertain about its own course of action, confidence erodes quickly. The Treasury Department has been managing its own set of crises largely out of public view. The national debt continues to grow at a pace that requires increasingly large bond auctions to fund government operations. Reports indicate that recent auctions have shown weaker demand than expected, with foreign buyers notably absent from their traditional role as reliable purchasers of American debt. This matters because the Treasury market is the foundation of global finance. When demand for Treasuries falters, interest rates rise, independent of Federal Reserve policy, and the cost of servicing existing debt increases, creating a feedback loop that becomes progressively harder to escape. Wall Street banks are navigating this environment while carrying their own vulnerabilities. Commercial real estate exposure continues to weigh on balance sheets as property values decline and loan defaults accumulate. Sources familiar with regulatory discussions suggest that several regional and mid-sized banks remain on watch lists for potential intervention. The memory of Silicon Valley Bank and the regional banking crisis earlier this year has not faded, and neither have the structural issues that caused those failures. Larger institutions have better capital buffers, but they are also more exposed to derivative positions and interconnected risks that become dangerous when volatility spikes. Trump has framed his demands for answers as part of a broader critique of a system that he claims is rigged against ordinary Americans. He points to the revolving door between Wall Street and government regulators as evidence of capture. He highlights the speed with which bailouts materialize for financial institutions, while working families struggle with inflation and stagnant wages. And he questions why the same officials who failed to predict previous crises are still in charge of managing the current one. These arguments are politically effective precisely because they contain elements of observable truth. The gap between Wall Street performance and Main Street reality has never been wider. Asset prices have been inflated by years of Federal Reserve intervention, creating wealth for those who own stocks and real estate, while pricing out those who do not, when these same assets begin to falter. The immediate response from institutional voices is to demand more intervention to protect values that were artificially elevated in the first place. This dynamic feeds public cynicism about whether the system operates for the benefit of all or merely for those at the top. Congress has been notably absent from substantive engagement with these issues. Legislative attention remains focused on political conflicts that generate media attention, while the technical machinery of finance operates with minimal oversight. Sources suggest that even members of relevant committees lack the expertise to challenge Federal Reserve or Treasury officials on complex matters of monetary policy and financial regulation. This knowledge asymmetry allows institutions to operate with effective autonomy, regardless of which party controls Congress. The international dimension adds another layer of complexity. Foreign central banks and sovereign wealth funds are watching American political and financial instability with growing concern. Reports indicate that diversification away from dollar assets has accelerated in recent months as major holders question whether the United States remains a reliable steward of the global reserve currency. This is not panic selling, but it is strategic repositioning that over time could fundamentally alter the financial landscape. China, Russia, and even traditional allies have been exploring alternatives to dollar-denominated trade and reserves. Each step in this direction reduces the unique privilege America has enjoyed since the end of World War II. What happens next depends on variables that no one can fully control. If Wall Street volatility subsides and confidence returns, the current moment may be remembered as just another episode of market turbulence. But if the pressure continues to build and institutional responses prove inadequate, the questions Trump is raising may become impossible to dismiss. The system depends on trust, and trust, once broken, is difficult to restore. The fact that these questions are being raised at all signals that something has shifted in how Americans view the financial institutions that shape their lives. Whether that shift leads to reform or simply deeper cynicism remains to be seen. But the panic on Wall Street is real, and the demands for answers are growing louder. And somewhere in that gap between what institutions say and what they actually do lies the truth about where this system is heading.